Welcome back to the podcast. This is the Financial Planning Edition, and I'm joined with Benjamin Klein. I was going to call you Ernest again. Benjamin Klein.
I should be so lucky.
How you doing?
Good. How are you?
Very busy. April has been a fun month, to say the least. And we've had not a great stock market in April. We've had some capital gains changes, budget changes. So many things we want to talk about. Ernest and I did a podcast, Ben, just last week, and we just posted it about Waste Connections, one of the stocks we've owned for a very long time. But we also talked about if you should make any changes to your portfolio, like on an investment standpoint, as a result of the capital gains potential changes in Canada, if this budget passes. The bottom line is we said, Baskin, we're not really going to change our investment strategy. We're not all of a sudden going to buy more dividend-paying stocks or fewer dividend-paying stocks or make a whole bunch of changes. But this is a very important podcast that we're doing today because we're going to talk about how capital gains changes and budget changes actually affect you and strategies that you should take and things we should take care of for you as a result of these sweeping changes. So we're going to get into it. We posted a blog on our website that you and David worked on. I can't remember what it's called. Fun with Numbers.
I think it is called Fun with Numbers.
Yeah, it's Fun with Numbers. And so we talked on that for our clients, and well, as anybody's free to read that blog. I think we gave some examples of what people should do with their stocks and the recommendation. I think the bottom line, spoiler alert, is you probably should do nothing with your portfolio, but there's a lot of caveats. And we're going to go through all the different facets and things that we're talking about with clients, what we're thinking about. Bottom line is the deadline is June 25th.
Yep.
So you have some time to decide. Obviously, it's not great timing. Accountants are busy in Canada doing your tax returns. What's the filing deadline? April 30th?
April 30th.
Yeah, so April 30th.
One more week.
They don't really want to answer your questions about these things right now. And of course, after April 30th, they have to work on corporate tax returns, which are due June 30th. So they're very, very busy. And so this comes at a very bad time. Anyway, that's life. This is the government you voted for. So, we all take the blame. So is this a political podcast? I'm going to not get into that. So, but we have a little political things on it, unfortunately. So Benjamin, walk us through the new budget by the Liberal government and how it affects you as Canadians and what we're thinking about.
All right, here we go. So in short, last week, 2 weeks ago, government announced the new budget. The big change to capital gains is this. For individual people, after June 25th or June 25th and beyond, whichever date it is, any capital gains that you trigger after you have triggered your first $250,000 of capital gains, so your $250,001 is taxed at a higher inclusion rate. Used to be 50%, is now 2/3.
Now, let me stop you right there. A lot of people have been so misinformed. They think they're going to be taxed at 66%. This inclusion rate is really confusing. Why don't you just walk people through what that means?
Got lots of questions about this. So the way it used to work and works until June 25th, when you realize a gain, you are taxed as if 50% of that gain was income.
Yep.
You do not pay 50% taxes. If you're in the highest tax bracket in Ontario, which is 53%, you would pay about 26% on your capital gain. So that 26 has gone up to about 35. It's now 2/3 of your capital gain is taxed as if it was income. So as an example, let's say that you bought shares of Apple for $10,000 Canadian, went up from $10,000 to $50,000. You're going to have a $40,000 capital gain. 50 minus 10 is 40.
Yeah.
When you sell those shares, let's assume you sell all the shares, you have a $40,000 capital gain. Under the old rule, you would be taxed as if you had $20,000 of income. Under the new rules, you would be taxed as if you had, $26,000 and change of income. So again, at the highest marginal tax rate, the old tax rate was about 26%. Now it's about 35%. But for individual people, regular folk, taxpayers, you only pay this new higher inclusion rate after the first $250,000 in a given year are taxed, or if you sell them, any of your shares, until June 25th.
So lots to unpack there, of course. So taking $250,000 of capital gains on stocks in a normal year is I would say a lot.
Yeah.
Something we don't typically do for clients unless we had a takeover or something, or we did a lot of trading, which we don't plan to do. So unless a client directs us, we're generally probably in a personal investment account or a joint investment account, we're probably never taking a $250,000 gain or more for clients.
Yeah.
It's just not what we do.
Yeah, very rare. I mean, maybe if the account is in the tens of millions of dollars, it might happen here and there.
If you're so lucky to have tens of millions of dollars in your investment account and we take more than $250,000 of gains, so be it.
And don't forget that $250,000, that's the capital gain. It's not necessarily the size of the sale. You might, if you need $500,000 for something, you might only have a capital gain of $100,000 or $200,000, depending on how long
that's right
they've been invested, how much money you made on your portfolio.
Okay, so under the old rules, if you pointed out clearly, you made $40,000 of Apple, that's your capital gain. You probably pay tax on that of $10,000.
Yeah.
So you bought Apple at $10,000, it's worth $50,000. You now get $50,000 into your bank account. You have to reserve $10,000 or $10,000 of taxes that have to be paid at some point in time.
Correct.
Under the new inclusion, if you're over the $250,000 threshold, you may have to pay
About $13,000 or so.
Yeah. So on smaller amounts, you're really not going to feel it. It really hurts people when they make gigantic capital gains in personal investment accounts.
Yeah. So a couple of situations that at least come to mind for me where this would be impactful. Number one, and I think most people have thought about this, the biggest one is if you die.
Yeah.
As most people know, in Canada, if you die, it's a deemed disposition of all your assets. So let's say you have, I don't know, maybe $1 million in your non-registered account and you die, and there are no other owners on the account. There's a taxable disposition. I tweeted out an example similar to this where there's a $700,000 capital gain on the account.
We're gonna link that tweet in the show notes.
Yep. Mm-hmm. So you're going to pay a capital gain on $700,000. You're going to pay tax rather on a $700,000 capital gain. Used to be under the old rules, or at least for the next 6 or 7 weeks, you would pay tax on $350,000 of income. That number is now higher. Of course, depends on your other goings on as well. But if when you die, that can be a significant unrealized or realized capital gain. If you sell a cottage, I think we're going to talk about that in more detail, that can result in a significant capital gain. Or if you need money for a major purchase, you're buying a cottage, you're buying some asset, you're giving some money to your kids, something like that, you can have significant capital gains in those years, and those should have more planning attached to them.
Okay, so obviously don't die. And of course, if you do plan to die and you have a spouse, you should have a joint investment account. If possible, obviously talk to your accountant to see if two partners have separate investment accounts and they want to commingle them. Obviously, talk to your accountant because there could be tax issues. But a joint investment account doesn't die. One of the spouses will die, but it's not a deemed disposition. But if you're the last remaining spouse, you're single, or you haven't commingled your assets, you on the date of your death, it's considered a capital gain.
Right.
And if you have below $250,000 of capital gains, you're no worries. You're still paying capital gains, but at the lower rate.
Yep.
If you have over 250, it's pro rata, right? The first 250 is at the lower rate. Anything over above 250 is at a higher rate and goes from there. Not much you can do to protect against.
No.
Well, we can't help you with that. We can give you good advice: eat healthy, exercise, but it is what it is.
Yep.
But what should people think about if? Okay, well, we'll be careful here, but no one knows when they're going to die, obviously, and we don't know either. We can talk about actuarial tables with clients. What are the potentials given your ages? But what should people be thinking about? Maybe they have aged parents. Maybe their parents are not healthy. They're concerned. Their parents are in their mid to late 90s. No one lives forever. What action items should be people thinking about as a result of these new capital gains changes?
Yeah. So as you say, of course, nobody knows how long they're going to live.
Yeah.
But according to the analysis I did, essentially, if you expect to either hold the investment or live, or for 5 years or less, there's a benefit to be had from realizing your gains now at the lower inclusion rate, as opposed to if you get unlucky. And if you die right after the rate changes, you might end up paying significantly more tax. We're not talking, enormous differences here. I think in the most extreme example, it could save you 5% of the value of your portfolio. But, on $1 million, that's $50,000. That's not nothing.
Yeah.
So according to what I looked at, if you're not in very good health, I mean, some people know that they might not have, unfortunately, so long to go, or they're in their, in their late 90s. Statistically, they're probably not going to be around for that much longer. Then it may make sense to trigger, a significant part or all of your capital gains now.
So great point. So, and this is advice that we were giving clients prior to the budget, where we had clients who have maybe parents in their mid to late 90s. They're not healthy. They want to know what we should be doing. Obviously, to always talk to your accountant, but it may make sense, as you said, to take capital gains, spread them out now. Our analysis, as you said, if you are going to unfortunately pass away or have a deemed disposition in the next 5 years, it may make sense to start realizing some gains at the lower tax rate. You have until June 25th to realize gains entirely on your portfolio at the lower tax rate, no matter if it's personal or corporate. So, I mean, there's time, not a lot of time, but these things need to be thought about, and we're here to talk to you about it. And we want to be included for our clients in those conversations.
Exactly. So in short, my recommendation to basically everybody who is not very old or doesn't have a parent or doesn't have parents who are very old or in poor health is you should probably do nothing.
Do nothing.
There is significant downside to selling your stocks early. And essentially, the downside is if you sell your stocks early, yes, you lock in a lower capital gains rate, but you now have to pay this tax. You have less money invested, and that money that's no longer in there can't compound, can't grow. I mean, it sounds obvious when you say it out loud, but that's the foregone profits, the foregone opportunity cost of paying taxes too early. So I've basically said to everybody who's 70 or younger, in many cases even 80 or younger, probably does not make sense to do anything here. There's really no benefit. But there are obviously other considerations. Again, if you come to think about things like selling a cottage, I mean, if you're thinking about it, I don't know if you want to rush into it, do it in 7 weeks. But there are certainly situations in which even if you don't have a huge capital gain on your investment portfolio, the higher inclusion rate might affect you sometime in the future.
So when these changes come out or there's deadlines, there's always, our brains always want to say, do something. You got to do something. You got to take advantage of this or that, because after this, it's going to be terrible. It isn't so bad. And you probably don't have to do anything. And just like investing, the market moves around and stock prices move around and there's bad news headlines that come out. And sometimes our clients feel like we need to do something. Take action, stupid. Don't just sit there. But I think this is, once again, for most people, and obviously we don't know everybody's circumstance, but the best advice is to do nothing. We talk about it on our podcast all the time. The power of compounding is so great that paying tax early is such a huge mistake. And capital gains tax rates move around. This is not the first time that they've raised capital gains rates. They've also lowered them. They lowered them in 2000. It used to be at 66% capital gains inclusion, or at the 33 or 38, depending on your tax rate. It dropped to 25. Now it's going back up again. There could be a new government in a couple of years. We don't know. This budget may not pass. We don't know. So you don't need to make rush decisions just because you feel you need to do something. Obviously, with a situation where you have an elderly parent or you're concerned about your time horizon, you should probably think about doing something. So that's number one. Cottage, investment property. Same thing, capital gains. People have, our primary residence in Canada, not taxed. There's no capital gains on the primary residence. You buy your house for $20,000, sell it for $4 million. Congrats, you're the winner. You don't pay any capital gains tax. Good luck finding another house, of course. However, the investment property, the cottage, taxed as a capital gain.
Correct. So, let's say you own a home and you own your second home in a cottage. And I think we all know what cottage values, we talked about this on our first podcast, have done in the last decade or so, but certainly since COVID. There's the potential that you could have a significant capital gain on your cottage, and it is fully taxable as a capital gain. And in just Do you need to do anything about it? No. As you said, capital gains rates might go back down. They might go back up. We have no idea. But clearly it makes it a little bit less attractive to have these kinds of second properties as investments. You know, I've always viewed these kinds of second properties and cottages as you're paying for entertainment. You're paying for an asset that, you know, you enjoy, and you may make money on it, you may not. Yeah, there's residual value. But, you know, clearly it makes it a little bit more expensive in the long run if you're kind of hoping to make money on the investment, and you know, maybe it'll pay for all the landscaping and maintenance that goes into taking care of a cottage. Well, it's going to be a little bit tougher.
I guess if you're thinking of selling this summer anyways, maybe this will speed you up. The problem, of course, is you don't want to get lowballed by selling at a stupid price just because you're worried about a little higher capital gains. So you got to do the math. It's very important. Okay, so Ben, there is situations where people should obviously take capital gains. We talked about possibility of a shorter time horizon, but liquidity needs. Yeah. Right. So talk about that.
Yeah. So some clients or some investors know that they're going to need some money in the near future. Maybe it's a significant amount. If that's the case, and it's going to come from the non-registered account and not a different account, and obviously you should talk to your advisor and your accountant about where to take the money from. But if that's the case, then it might make sense again to raise some money now, pay the capital gains that you would eventually have to pay anyway, but take advantage of the several weeks that you have at the old inclusion rate. I had a client today who knows she's going to need some money over the rest of the year. So we just said, you know, let's raise the money that we know you're going to need in the summer, and a little bit more, you know, for your year's expenses, and, you know, hold that in cash. Of course, you have to talk about if it makes sense to sell stocks, and and you know what good timing is, and of course fixed income and cash is a little bit more rewarding, that kind of thing. But you know, makes sense if you have liquidity needs. You might as well do it before the capital gains.
Absolutely. So obviously another conversation to have with your advisor. You're thinking of gifting money to your children. You're going to do it anyways this year. You have big capital gains. Have that conversation. You have stocks that have done incredibly well in your portfolio. They're gigantic weightings in your portfolio. Our approach for clients, Ben, is we like to risk manage, right? We don't ever want a stock to get gigantic in a portfolio. We tend to trim them back when they get to 8 or 10%. We like to start out at equal weights of stocks when we build out portfolios. It may not be the stupidest idea to take a capital gain on a stock. Of course, you know, if it goes a lot higher, you'll be sad, but that's life. These are some things to think about. If you're going to need the money anyways, and you're thinking about trimming that stock anyways, you could think about taking some action. Okay, so we talked about personal investment accounts, and there's things that people need to consider. But trust and corporate accounts, you only have the deadline, and then you're paying full tax rate no matter what.
Correct. So in trusts and corporations, you have until June to trigger capital gains, and you still get the old inclusion rate. After that, every dollar from the first dollar of capital gains that you realize is taxable at the new inclusion rate. So that, you know, obviously makes those types of vehicles a little bit less attractive, and, you know, you should talk to your accountant about that and whether it still makes sense or not.
Yes.
But in those cases, particularly if you know you need to have a liquidity need from one of these kinds of vehicles, then obviously that makes it more attractive to do that sooner rather than later.
No, so of course, corporate and trust accounts, people set them up to defer taxes. Many working professionals, accountants, doctors, lawyers, business owners, you name them, create these professional corps. These hold corps to defer taxes because it allows them to pay lower income tax rate today. We're going to pay that tax in the future anyways. Don't be so upset about it. It is what it is. But there are things, of course, you can think about and talk. I mean, this is where you really need specialized accounting advice. Unfortunately, your investment advisor can't give you this type of advice. There are things called estate freezes. There are things called the capital dividend account, where if you took capital gains and you had material capital gains, you may be able to strip out some of that tax-free back to you personally. Those are strategies that people use regardless of the tax rates. You get money into the corporations. How do you get them out of the corporations? If you took capital gains anyways, you can sometimes get money out of your corporation tax-free. although you still have to pay the capital gains tax.
Yep.
So those are issues that you need to talk to your accountant about. I bet if you got 12 accountants in a room, 6 would tell you to do this and 6 would tell you to do that, right?
Yeah. Yeah. I mean, it significantly you're making expectations about what the market's going to do, what is going to happen to capital gains rates going forward, changes to tax. Nobody really knows. And, you know, we generally, I think as a firm and as advisors, try not to guess where things are going to go from here. I don't think there's really any benefit to doing that. All we can do is see what, you know, the current budget says and what our best guess says is going to change and try to plan based on that.
So the blog that you and David worked on and gives an example. You assumed that by doing nothing your portfolio would compound at what rate?
6 or 7%.
6 or 7%. Generally, well, we don't know what stock markets are going to do, but I think I read the S&P 500 over the long term has done about 9%.
Yep.
Right. So if you thought you were great at stock picking and your portfolio would do very, very well, more than the example Ben gave, it may make even less sense to take capital gains. Of course, if the market does lousy for the next 10 years and you picked terrible stocks that are all going to go down, or they're overvalued, anything could happen. So this is why it's so impossible to give anybody the correct answer. As you said, all we know is we have this information at hand. We know how our stocks have done to this date. We know what unrealized gains you have. We know your age. These are the things that we can try and figure out and help you with.
Yeah. So, I mean, as you say, if returns are better than expected, then taking that haircut early and losing the benefit of compounding on those on that investment is even more punishing. And so, you know, I think in general, if anybody's takeaway is what should I do here, unless you have a good reason to do something else, you should probably just do absolutely nothing.
Yeah. So I think if we can sum it up, your actions that you could take: do nothing. Maybe take some gains if you need to at a lower tax rate before the deadlines. Maybe spread those gains. You can take those gains at a lower tax rate under the $250,000 threshold for personal investment over a number of years. That's another action item you could take. Obviously, talk to your accountant because there are more specialized strategies one can do, whether moving assets to a corp, whether taking advantage of the capital gains, the capital dividend account, and estate freeze. You could also consider buying some type of insurance. People have purchased insurance products that protect against their corporations the capital gains upon death. This may become very important. Maybe you want to take capital losses. I don't know. It's lots of variables there.
I had a very clever person on Twitter note to me that, oh, great, capital losses are now more valuable. I think that's playing 4D chess, I think, is a little bit the term to describe that. But sure, you know, capital losses are now a little bit more valuable than they used to be. But as you mentioned, I mean, insurance, very common in corporations, very common to protect, you know, against things like the capital gains due on maybe your death or sale of your business, something like that. That now becomes more expensive because you have to pay more on the insurance. You need more coverage. One note that I think I haven't seen talked about very much is they are actually proposing to increase the capital gains exemption for qualified small businesses, which is nice for us.
Yeah.
So, you know, if a lot of your capital is tied up in your small business that you hope to sell down the line and have a capital gain on, well, you won't be paying quite as much on the new capital gains taxes as you were before.
That's right. If you have a saleable small business, the first now $1.25 million of capital gains won't be taxed, which is an increase from the $1 million.
Yep.
And it's going to grow from there. I think there's also a new entrepreneurial lifetime capital gains exemption. I don't know how that works quite yet, but there's a potential to add another $2 million of lifetime capital gains exemption. So one could theoretically imagine someone creating a business, a startup, and having the first $3.25 million minimum tax-free.
Yep.
As from capital gains.
Yep.
That's the offset. Doesn't help us very much.
Not yet.
Not yet, but these are things to consider. And of course, there's always a potential, like we talked about, that changes could be made to, your capital gains rate or other taxes. So as always, I mean, this stuff is a moving target. Yep. Anything else you want to add there that we didn't cover?
No, I think that's really it. I mean, the reality is the government has come out and said there's only a tiny proportion of Canadians that are affected by this, and I think in general that's true.
Yes.
I think that's maybe a little bit misleading. I think they said something like 0.13% of Canadians. I think that's very low. And as David tweeted, he probably saw it, that something like 10% of Canadians own second homes. Not all of them probably have capital gains of more than $250,000, but some of them do. In any given year, maybe that's right, but it could affect a greater proportion of that. But even still, there needs to be a good reason behind making changes just as a result of tax regimes. We kind of think as a firm in general, because tax regimes are, first of all, unavoidable, but also unpredictable, generally, your investment planning, your financial planning should take precedence over planning purely from the perspective of minimizing taxes.
Yeah. So we're going to always take our lessons from Warren Buffett, who has said that the greatest gift you're given is the ability to defer taxes by not selling your winners. And if you have good investments and you believe that they're going to continue to compound and grow going forward, then paying taxes early is probably always a mistake. And the types of investments that we're looking for our portfolio, companies that can reinvest their cash flows at high rates of returns, companies that are run by strong management teams that are, have strong competitive moats, competitive advantages. We really believe that the portfolio of companies that our clients own will continue to grow in value over the long term. Maybe in the short term, who knows what's going to happen. And so I can tell you what I'm doing personally with my holding corporation and my stocks. I'm doing nothing. I'm not selling any of my stocks. Obviously, I'm not 90 years old, so people would have to consider, but I have no interest in paying any capital gains tax to anybody. I'll leave that to be someone else's problem.
Yep. And Warren Buffett always liked to say that he pays more tax than his secretary because all his money is capital gains, and all of the secretaries is
he pays less tax.
He pays less tax because the capital gains rates are so much lower. So I don't know. Maybe he thinks this is a little bit more fair. We can take a lesson from him there too.
Just before we finish off, anything else in the budget that our clients or people listening should think about?
Not that I've seen. I mean, I've done a little bit of reading through the various proposals. I haven't seen anything that's hugely impactful. This is, I think, by far the thing that people are talking about most. I mean, one side note is that there was no change to the principal residence capital gains exemption. There was some talk about, clearly there's a lot of money to be gotten there if that was eliminated or changed. So that's, still a benefit to homeowners. And
you can't write off your mortgage as yet.
No, interest. Not yet. Not like in the States.
That's the offset in the U.S. is you're allowed to write off your mortgage. But the benefits, of course, of Canada, and a lot of Canadians have gigantic unrealized gains in their homes. I think there would be insurrection on Capitol Hill if that was changed.
Yeah, I think that would have to have very specific, grandfathering requirements and what exactly that would look like. But it didn't change. So, lucky for you if you were still on the house.
And how did we get into this pickle to begin with, Benjamin? Countries have gigantic deficits.
Yep.
We have funding issues. We have high interest rates that the governments can't afford to meet, and so it is what it is, right? Hopefully they can rectify some of these situations by taking more capital gains. We're hopeful that was the right decision. We have to trust the government that will work out. We'll see, and time will only tell.
Yep, nothing we can do about it except plan and try not to pay any more than you owe.
So the takeaway, just to reiterate, for your investment portfolio, the way we manage your money, we're doing nothing, right? Yeah, I was waiting for you.
For pretty much everybody.
Pretty much everything. For your estate planning, your financial planning, we're going to reach out to those that we think need to make decisions, but the rest of you, obviously reach out to us if you have any questions. We'll be happy to go into more detail about our thoughts and what we're thinking about. And for prospective clients, always happy to talk as well.
Thank you very much.
See us back here real soon. Take care.